Hello everyone. Nigeria, the giant of Africa, has long been viewed as a nation with enormous economic potential. For over 6 decades, Nigeria has stood as a paradox, a nation endowed with immense human capital, vast fertile lands, and staggering mineral wealth. Yet, Nigeria has perpetually struggled to translate these endowments into economic development and prosperity for its people. At independence in 1960, agriculture accounted for over 60% of GDP and more than 70% of employment. Nigeria was one of the world's top exporters of cocoa, groundnuts, palm oil, and cotton. Regional governments competed economically, and public institutions were relatively efficient. But since then, the reality has been starkly different. The nation's economic performance has been marred by cycles of economic boom and bust, widespread poverty, and industrial underdevelopment. The trajectory of the key economic indicators, such as GDP growth, GDP per capita, manufacturing contribution to GDP, infrastructure development, and human development indices, has been a story of volatility, missed opportunities, and persistent economic underperformance. In this video by Africa Rebound, we journey through this complex history, dissect the root causes, and peep cautiously into Nigeria's economic future. At independence, Nigeria inherited a relatively diversified agricultural economy, built on robust agricultural exports of cocoa, palm oil, groundnuts, rubber, cotton, etc. The early 1960s witnessed appreciable economic growth and investments in education, infrastructure, and manufacturing. However, the seeds of future challenges were also sown during that period, with regional tensions and a reliance on commodity exports, which are subject to volatilities in global prices. The political crisis of the mid-1960s culminated in a civil war between 1967 and 1970 and disrupted the economic development trajectory. Post-war reconstruction coincided with the global oil boom of the 1970s, which quickly shifted Nigeria's economic base from agriculture to crude oil. The discovery and exploitation of vast oil reserves in the Niger Delta fundamentally altered Nigeria's economic DNA. The 1973 OPEC oil embargo sent prices skyrocketing. Oil revenues poured in. Suddenly, Nigeria was awash with petrodollars. GDP surged, creating the illusion of prosperity. But this was deceptive. Nigeria caught the Dutch disease. By the mid-1970s, oil accounted for over 90% of Nigeria's export earnings and 80% of government revenue. Per capita income increased, but the growth was shallow and non-inclusive. Agriculture, the bedrock of the economy and the primary employer, was systematically neglected. From over 60% of GDP in 1960, agriculture plummeted. Crucially, oil wealth became the primary source of government revenue, cutting off the critical link between taxation and accountability. A culture of rent-seeking, whereby the focus is on capturing a share of the oil wealth rather than generating new value, became deep-rooted within the political and bureaucratic elite. The 1980s brought in economic turbulence and the inevitable crash. Global oil prices collapsed. Nigeria's over-reliance on a single volatile commodity was brutally exposed. The country plunged into a deep economic crisis. Under pressure from the IMF and World Bank, the military government implemented the Structural Adjustment Program, SAP, in 1986. The goals of SAP included liberalizing trade, devaluing the local currency, removing subsidies, privatizing state-owned enterprises, and, of course, diversifying the economy. But at the end of the day, it brought so much pain without sufficient gain. Although SAP succeeded in addressing short-term fiscal imbalances, it devastated local industries and worsened poverty. It brought severe economic hardship in the form of high inflation, mass unemployment, crumbling public services, and a dramatic decline in living standards. Devaluation made imports highly expensive without adequately boosting non-oil exports, mostly due to underlying structural weaknesses like power, transport, and skills. Politically, this period was marked by prolonged military rule and political repression. Economic policy became increasingly erratic and short-term in nature. The return to democracy in 1999 brought high expectations. The early 2000s saw another oil price boom, generating unprecedented revenue. Nigeria introduced banking reforms, liberalized the telecommunications sector, and engaged in debt relief negotiations. In 2005, Nigeria exited the Paris Club debt trap after paying $12 billion to cancel $18 billion in external debts. Telecommunications boomed, the banking sector expanded, and GDP began to rise. Between 2003 and 2014, Nigeria recorded average annual growth rates of around 6 to 7%. And in 2014, Nigeria rebased its GDP to emerge as Africa's largest economy with a GDP of over $500 billion. But again, this growth was deceptive. It was growth, but without economic development, mostly driven by high oil prices and services sector, especially trade, telecoms, and real estate, not from the real sectors of manufacturing or agriculture. Unemployment remained high, inequality deepened, and the structure of the economy remained fragile. The persistent structural flaws remained largely unaddressed. Despite massive spending, electricity generation was still abysmal, crippling industries and small businesses. Roads, ports, and railways were chronically underfunded and inefficient, thus increasing the cost of doing business. The economy remained highly dependent on oil exports for foreign exchange and for government revenue. Macroeconomic mismanagement was also a big problem. Profligate spending during boom times left little in savings despite the creation of the excess crude account. Foreign exchange reserves were poorly managed, and the central bank often engaged in costly, unsustainable interventions to defend an overvalued naira. From 2015, Nigeria's economic vulnerabilities became more exposed. The collapse of global oil prices between 2014 and 2016 pushed Nigeria into its first economic recession in 25 years. Inflation surged, the naira lost more value, and investor confidence waned. Attempts to manage the foreign exchange crisis, including a move towards a more flexible exchange rate and restrictions on imports, had mixed results, often creating scarcity and arbitrage opportunities. Government borrowing surged to finance budget deficits, raising concerns about debt sustainability. The escalation of the Boko Haram insurgency, herder farmer conflicts, banditry, and separatist agitations devastated key agricultural regions, displaced millions, disrupted supply chains, consumed vast security budgets, and diverted scarce resources from economic development. The 2020 COVID-19 pandemic triggered another recession, Nigeria's second in 5 years. Government revenues plummeted, debt levels soared, and the number of Nigerians living below the poverty line increased dramatically to over 80 million people. GDP growth rate was low, barely keeping pace with the population growth rate of around 3% per annum. GDP per capita effectively stagnated or declined in real terms for nearly a decade. The manufacturing sector struggled under high energy costs, foreign exchange scarcity, insecurity, and weak demand, and inflation remained stubbornly high. Unemployment and underemployment, especially among the youth, reached crisis levels. Nigeria failed to structurally transform its economy. In summary, Nigeria's economic journey from 1960 has been a stark lesson in how natural resource endowment without visionary leadership, strong institutions, and disciplined governance can become a curse rather than a blessing. But could there be a twist in Nigeria's economic tale? Perhaps, and why not? Since taking office in May 2023, President Tinubu has launched what many call Tinubunomics, a set of bold, sometimes brutal economic reforms intended to overhaul Nigeria's macroeconomic landscape. On his very first day in office, he discontinued the long-standing petrol subsidy, almost doubling fuel pump prices overnight. He also unified the previous multiple exchange rates into a single market-driven rate, which has remained stable. Although the subsidy removal has freed up resources for infrastructure development and for increased revenue allocations to subnational state governments, it has led to a higher cost of living and widespread public backlash. These reforms represent the most aggressive and decisive shift in Nigerian macroeconomic policy since the 1986 Structural Adjustment Program. They squarely address historical structural bottlenecks, fuel subsidies, multiple foreign exchange rates, and policy inconsistencies that have long hindered real economic growth. But the short-term social cost is very steep, and the benefits are still largely prospective. Whether or not the expected investments and economic growth actually materialize will depend on continued governance discipline, effective implementation of infrastructure projects, industrial policies, and social support programs to cushion the shocks and the pains of reforms. Of course, ending insecurity is also imperative. So what must Nigeria do to really fix the economy? First, Nigeria must reduce its reliance on oil. This requires deliberate investments in agriculture, agro-processing, light manufacturing, and technology-enabled services. Second, reliable electricity is non-negotiable for industrial growth. The power sector has to be fixed, with the right regulatory reforms and private sector investments. Third, without a sufficiently skilled population, Nigeria cannot compete globally. Therefore, vocational and STEM education must be scaled up. Fourth, like the Asian tigers, Nigeria must focus on manufacturing goods for export, such as garments, electronics, processed foods, etc. And fifth, transparent leadership and efficient public service are vital for investor confidence and policy continuity. The Tinubu administration has dared to rip off the economic band-aid by confronting the systemic distortions head-on. This marks a pivotal point that, if well managed, could unlock Nigeria's long-awaited economic transformation. However, without visible relief or quick wins in the short to medium term, these economic reforms risk becoming a cautionary tale of right medicine, wrong dosage. Tinubu's presidency could be the breakthrough or breakdown era for Nigeria's economy. Only time and disciplined execution will reveal whether Nigeria emerges as a developed economy or remains a 65-year-old toddler clutching the same promise of a better tomorrow. Happy Independence Day. May God bless Nigeria. Thanks for watching.